don't think we've ever had such an exciting time to be an investor than it is right now, and especially approaching 2018. It's not going to change. It's going to roll right into 2018. I've kind of changed my perspective on where I think this market is going to go. I believe we're going to continue higher on this market, and I know I've got a lot of brand new investors out there. The challenge for me on this particular program, and what I really strive to do, is put myself in the position of a particular viewer out there that's looking at how we can approach this stock market 2018. You know, what if I'm a beginning investor? How do I approach investing in 2018? Is it too late to start investing? All right, guys, thank you for tuning in. This is the Independent Investor Channel. My name is Ryan Wolfilman from New York. I thought it fitting to come out with a 2018. I'm going to do 18 stock picks, guys. I cover hundreds of stocks, all right? So this is really not a problem, but it kind of blows the top 3 and top 5 and top 10, blah, blah, hippity hoopla, right out of the water. I'm going to give you 18, okay? And these are 18. I scoured over my watch list to provide this to you guys, really with the perspective of helping a new investor look at how we can approach and get some exposure into the stock market in some of these picks that I feel really kind of sat on the sideline. Of course, they've appreciated a little bit over 2017, but the majority of these stock picks, minus a few, are under $50, okay? Which in a stock market right now where the average stock price is pushing a 20 multiple right now, which means that it's relatively expensive of a market right now. I tried to pick the 18 stock picks that come January 1 or come tomorrow, you guys could actually put positions on as we approach the year end. All right, guys? So please enjoy. And I'm going to fire through these rapid fire. I'm not going to go into detail on these. I'm just going to offer these for you guys kind of rapid fire. And the first two, Pfizer and Merck. These are long-term holdings of mine, along with Johnson & Johnson. I just think, contrary to Johnson & Johnson, Pfizer and Merck both kind of adjusted down, especially Merck, into the mid-50s here, and I think it's a steal. I think you're getting a great company with a great dividend. Pfizer, same thing, in the upper 30s right now, with also a phenomenal dividend. So as a beginning investor, these would be the places that you guys want to kind of look, okay? You'll see all kinds of different stock recommendations, and I'm a best of breed investor. I'm always looking to identify the very best company out there in any particular sector, and these two, there's no better representation in the healthcare sector than Pfizer and Merck, all right? The third one is Disney. Disney sat most of 2017 out, and it was real hard for me to continue to hold the stock. Not really. As a value investor, I'm proud to own Disney long term, and I don't mind recommending to you guys, basically what you're getting is, you know, a free year off, basically, of sitting on the sidelines as a stockholder in Disney, and probably be able to profit from some of the accumulation going forward once this Fox deal closes, and I believe that it's going to, all right? With the momentum created by the new Star Wars movie, the accelerated growth at their parks, the expansion worldwide, and the content that Disney has is second to none. And as they've pulled away and they're going to try to offer that content a little more exclusively, I think Disney is going to be a place that you're going to want to play, guys, as a consumer discretionary play, all right? The next one is probably the top one on this list. I kid you not, guys. And it's easy to overlook this name. I don't know if a lot of you guys out there have actually heard of this company, but Mondelez is probably my #1 stock pick. Now, I've owned Mondelez for the last couple years, and it really hasn't done a whole lot. It really hasn't. But as a diversified snack play business, a lot of international exposure. Of course, their Oreo cookies, Ritz. There's a whole Cadbury. They've got a whole suite of products that they represent, and at just at $43 a share, it's a great entry point. Pays a nice dividend, and so for a value investor, it's a great play. The next one is China Mobile. China Mobile's probably #2 on this list out of all 18 of these stocks. it's been my job throughout this year to really scour over the market and try to identify where the value is in this market. China Mobile, I don't get what's going on there. We're talking about a 12 PE ratio going forward. We're talking about a $200 billion company. We are talking about the largest telecom services provider. They have expanded into London, England. They are going to be expanding going into 2018 in their 4G business. It just doesn't get any bigger, not to mention an almost 4% dividend to boot. And if you're willing to take a position in China Mobile now, investors should be paid off going forward, because it's sitting at a 52-week low right now, guys. The next two are my oil service providers. So as oil has ramped up, we started the year going into last fall, dipping down into the $25 a barrel oil. And now as we're approaching $60 a barrel oil, a lot of the majors have moved up. I actually took that move in oil and profited quite handily, I might add, from that. You guys might recall a few months back, I was really heavy oil. I've trimmed that position down all the way to my core holdings, which are Chevron, Halliburton, and Schlumberger. And there's no better than Halliburton and Schlumberger. I could honestly, I think I would give the nod comparing these two to Halliburton. I really would, but Schlumberger is the best of breed. They're number one. They are the largest, all right? But these two right here, if you're looking to get oil exposure, probably pretty safe play taking long positions in both Halliburton and Schlumberger. Verizon, long-term holder, and finally, oh my goodness, finally Verizon has actually started to move. Now, keep in mind, I've owned the stock for the last half a decade. I've been paid dividends the whole time. I've reinvested those dividends, but I'm starting to actually enjoy some capital appreciation, but it's not too late in the low 50s to pick a position in Verizon and just take a long position on Verizon and enjoy some capital appreciation going forward, right? I'm giving you guys a pretty good entry point after multiple years of sifting down into the low 40s up into the low 50s, guys, and I think it's going to break out of that trend, all right? Intel, you're talking about free cash flow of $10 billion. You're talking about an anticipated of upwards of $17 billion on Intel. You're talking about a market cap of $220,000 and an entry stock price of around $47, $45, $45 here. For an entry-level investor, guys, it's not necessarily going out there and looking for the Amazons and the Nvidias of the world. Intel will get it done for you guys. It's going to pay you that nice dividend. It's going to give you that capital exposure to the chip market. These guys are the best in breed, and it's going to get you started the way that I expect you to be starting. If you're sitting there and you're saying, gosh, Ryan, I don't know where to start, give me some good quality stock picks that I could get started and actually consider myself an investor and not a non-investor sitting on the sidelines. Guys, this is how you do it, because this stock throughout 2017, yes, has appreciated, but not quite as much as the overall technology run. All right. Lowe's. I've watched Home Depot go through the roof. Lowe's I actually like better, and Lowe's has actually been on the sideline. If you want an alternative play, Lowe's has exposure in not only the U.S. but also Canada. They have some exposure to the home services, right? And there's no two companies that are better than Lowe's and Home Depot. If you want the value play, you can go ahead and pick up the Home Depot. My fear is that it's run up so far this year. I think an alternative strategy here is to go ahead and play it with the Lowe's play in the upper 80s, guys. Oracle, the phenomenal, it's actually come below and adjusted below 50. I think you're getting a really good entry point on Oracle and the cloud play business, the international or the enterprise cloud business from Oracle. It's a stock that I personally own. I've just recently taken a position in Oracle, and I'm happy to do it. Actually, some of the parts analysis, we're talking about it trading at its current share price at less than its actual value. All right. Coke. I've been a long-term holder of Pepsi. Pepsi's run up, and I really wouldn't recommend that a new investor look at Pepsi right here at 120. I do believe that the stock continues to run above 120. I really do. But Coke right here at 45 with a fat dividend, also as a value play, as a beginning investor, wouldn't it be nice to hold a few shares of Coke? I mean, 10 shares of Coke runs you $450. If you guys are talking about a strategic, real allocation play within these self-directed accounts that I'm having you guys start, why not look no further than Coca-Cola? Invest like Warren Buffett, man. There it is. There's your play right there. Coke will get it done for you. All right? General Electric. I scoured over the entire industrial sector for you guys, and I scoured over the entire defensive sector. And even though I've recently taken a position in Northrop Grumman with their acquisition of Orbital ATK, that was my favorite one, but I believe I paid up for it. I cannot justify taking a position across the defense sector, even though I love it. I love Lockheed Martin, I love Raytheon, and I love Stryker, I believe is the other one that I cover. I love them all. The valuations that I'm looking at are pretty steep, guys. These have run up pretty tough. And when you talk about a contrarian play in the industrial, there's no better play right now than General Electric. And I know some of you guys are going to beat me up, but guys, at $150 billion of market cap, you're paying $17 a share. Guys, 100 shares is going to run you $1,700. Cut that in half, and you're looking at, you know, $850, guys, for 50 shares of General Electric. I feel confident recommending this if you're willing to wait and be patient for this restructuring. The dividend has already been cut, but you're still getting paid a 2.2% dividend. And once they start to figure this out, you're going to own a nice cornerstone in your portfolio of really one of the legacy industrial companies of our time. All right. Cisco, kind of the same idea as Intel, even though I think Intel is a premium play. Cisco is right there with your huge market cap, huge dividend, and I think as an value investor, to get into Cisco right here would be an excellent entry point to the technology sector without having to go in there and chase Apple or chase Nvidia or chase Google or Facebook, okay? The Blackstone Group. I've recommended Blackstone Group. I've held Blackstone Group for many years now. I've enjoyed the dividend. Right here at the stock price that I'm recommending to you guys is about the stock price that I paid for it some 5 years ago, okay? And I rode it all the way down to the low 20s, and I'm recommending it to you guys back kind of at that share price, and at $30 a share. You're not getting any better. This is the highest dividend payer in the group here at Blackstone Group with about a 7% dividend, and it's a healthy, sustained dividend, all right? It's kind of a contrary to the rule of an unsustainable dividend. Not the case with Blackstone Group, all right? My remaining three are from the telecom sector. You guys are going to kind of understand a theme in these names here. The telecom sector has been out of favor, okay? Now, you can beat me up over that if you'd like. You can continue to go with the in favor sectors and be disappointed when the sector rotation starts. Where's that money going to flow to? That money's going to flow out of the high flying technology, and it's going to fly right into these stocks right here, these telecom names, all right? So I basically got the entire telecom sector represented here in this group of 18, all right? And the last three are Vodafone. We're talking about India, and we're talking about Europe. Cellular phone provider in Vodafone. We're talking about Comcast. Phenomenal play here domestically. And then finally, we're talking about the behemoth, the very first stock that I ever bought in my entire life, which is AT&T, paying a fat 5.25% dividend. And I do not mind recommending that for any of my new investors out there that's looking at how we go about strategizing here in 2018. Guys, I hope you enjoyed this video of my top 18 picks for 2018. I had some people kind of asking me a little bit about some stocks to keep in mind. I will always continue to provide those stock picks to you guys to help you guys understand how it is once we get into that phase 2 that I talk about and you've started the account, how it is to go about funding that account. I would look no further than these 18 names here, guys. This isn't the all-inclusive list either, all right? It doesn't mean that you can't buy an Apple. These are just some of the ideas that I feel like are really, really a good value right now for you guys. If this is your first time tuning into the Independent Investor channel, please hit the subscribe button. Leave your comments at the bottom if you have any other ideas about how we can approach this coming 2018, a year-end review of both 2017 and also approaching how it is that you're strategizing for 2018. Leave those comments, and if you know anybody out there that's looking to get involved in the stock market and looking for a little bit of information, easy delivery over YouTube, guys, share this link with them as I respond to every single one of my subscribers, and I'm glad to do it. Guys, thank you so much for tuning in, and good luck in your investment future.